This conference will now be recorded.
All right, for our fourth and final installment of this combined week 10 and 11, we are going to finish out with depreciation and how tax is similar, but in a lot of ways different than the accounting 101 that you have previously learned with straight line depreciation. All right, so in tax, they break down property into two types, and these are business property. Notice the confusing terminology they use for the first piece. They call most business assets, they call it personal property. Very confusing. It's not personal, it's actually business property. It's machines, it's couches, it's copiers in your business. And then there are buildings, which they consider real property. Buildings and land, so that would be apartment complexes and warehouses. Personal property is not the same as personal use property. Personal use is actually what you use for you yourself, not in the business, so your own personal car. Personal use property is not deductible, you can't depreciate it, nothing like that. There's nowhere to put that on the 1040. You're only allowed to do that with business assets. So with business assets, if you opt to do regular depreciation, which you'll see is not the most common thing to do right now, but you can opt it. And for really, really big businesses, you may have to do this what is called makers, which is it's kind of like a straight line, but just double in a way. Makers is the modified accelerated cost recovery system. This is a terminology you just want to have memorized whenever you go into a business setting and they talk about taxes and business depreciation. You need to be able to use the term makers and know what that means, that it's the tax way to depreciate, which is, you would say straight line would be one of the ways for accounting 101. All right, with taxes, they tell you what useful life your asset has, which is different than accounting 101. Accounting 101, you pick the useful life that you think you'll be using your asset. Not so much in tax. They tell you it's typically one of these two. 90% of the assets that are not real property will be one of these two. Some weird things are like sewer systems is one that's weird, maybe wind turbines. It's weird things that most businesses won't have. Almost all property will be one of these 2 years, 5 or a 7-year life. And you can see the ones that I've put in here for the two different types. Basically, the ones that you use a lot and that are technology related, these are the 5-year lives. Your normal equipment, like a saw or some other machines that you use, or any type of furniture, is considered a 7-year life. Now, the real property, the buildings, they are in two categories as well. Residential real property, 27.5 years. People ask, how did they get that? I don't know exactly, but my guess is whenever there's laws added into taxes, Congress has to pass it. The House submits a version and the Senate submits a version. So my guess is the House submitted something like 25 years for a residential property like apartment buildings. The Senate said 30 years, and then they just took the average. That's a lot of times what they do. 39-year life, probably something very similar was done. Non-residential real property for any factory warehouse or warehouses. All right, you start your depreciation when it's placed in service. Now the tables that you're going to want to use, they're in the back of the book. Not the back of the book, the back of the chapter, chapter 6. So if I would do this now, turn to the back of chapter 6. And the primary table that we're going to look at, the one that's going to have 90% of our personal property, our business normal assets, is going to be on page 6-45. And it's going to be that top box, what's called the half-year convention. The half-year convention basically says that all assets that you purchase, no matter if you purchased it in January and February or November and December, they assume you used it for a half of a year, regardless of when you actually put it into service. just to make it a little easier. So when you see the 5-year property, well, they really have 6 years because that first year is only a half and the last year is only a half. So that's why there's 6 years or 8 years for a 7-year property. All right, so let's see how these tables are used. If I purchase an office machine, furniture, for $4,000, it's key that it's office furniture. So you're going to have to go back and think, which is it, a 5-year property or 7-year property? $4,000, and I purchased it in May of 2018. And I want you to be able to tell me what's the depreciation going to be year 1, year 2, and then in year 3 when I sell the machine later. All right, so I'll kind of walk through this one with us since we've never done these before. With this one, we take $4,000, and this is a 7-year property because it's furniture. So we look at our 7-year chart there on the 6A-1 table, and it says 14.29. That 14.9 is already cut in half. The tax table year 1, and all year 1 numbers are already cut in half from what they normally would have been. So that 14.29 is already cut in half. You don't have to worry about doing that. So we're simply just going to take 4,000 times 14.29 to get our answer for year 1. And then year 2, we take 4,000, again, the same price, and multiply it by 24.49% to get the year 2 amount. Now, the only thing that I changed up then was I tell us that we sell the asset in 2020. If we sell the asset partway through the year, we can still take some depreciation for the use of it for half of a year. Because it doesn't matter when I sell it. If I sell it in February or November, I still used it for, in tax purposes, a half of a year. Now, the tax tables, though, only have half years built in the first and the last year. So when you look at year 3 of 17.49 in the tables, they're assuming a full year. So we have to take that number and cut it in half. So we take the 4,000 times 17.49, but then cut it in half, and that's how much depreciation I'd be allowed to take in that 3rd and final year that I had the item. All right, now let's look at the difference then between personal property using that table and then something like a warehouse. We'll get to the other tables here in a second, the 6A2, 3, 4, and 5. But now turn the page, actually 2 pages. Table 6A6 on page 6-48, that is for residential property. And then table 6A8 is for warehouses, non-residential property. So we're going to be using the non-residential down there at the very bottom of page 6-49. And what's different about, as you can see on the table, they actually go by month. You see month 1, 2, 3, 4 along the top, and then along the side is the years. So it is important on when we buy and put it into use. Our assets, we got to know the month, especially for that year 1 and the year that we sell it. Okay, so in this one, I go to 2018, or I find the depreciation for year 1 on a $300,000 non-residential. So 300,000, and then I look up year 1, month 8, and that's 0.963. So I don't take it by that number, that's the actual percentage. So to find the decimal, I got to add 2 zeros to the front of that. So it's really 0.00963. So the numbers that they give you are always in the percentage. So we've got to tack on a couple extra zeros to get to the decimal. So we're allowed to take 2,889 for that first year when we had it for a partial year. Now in year 2, so we go down for the same month in August, we go over to year 2, and it's going to be the same as you can see, years 2 through 39, 2.564. That's a percentage. So I'm allowed to deduct another $7,692 in each of those years that I have it. And then in the final year, let's say I sell it in year 3, I can't then use the 2.564. I have to pretend that this is year 40. And if I sell it in July, I go over to the 7th month for July in the year 40 for my final year, and that's the percentage that I have to use. So 1.391 is the percentage, so as the decimal here, 0.01391 would be how much I can depreciate. Now, I said we'd get back to those tables there in the middle, the 6A-2 all the way through 6A-5. Those are considered mid-quarter convention, and they aren't used a lot, so I'm not going to really spend much time about talking it. I have an example that you can go through, and I'll have the answers attached. But essentially, you have to use this method if more than 40% of your assets for the year were purchased in the last quarter. So basically, the tax law didn't want you, at this time that this law was made, they didn't want you to try to lower your tax bill by buying a whole bunch of goods that you could then depreciate and then lower your tax bill. Now they actually kind of want you to do that. So this one is kind of going away. It's kind of out of style. That's why I'm not going to spend a lot of time. But basically, that's what those charts are for. If you have to use the charts, then you have to separate each asset into which quarter it was bought. So that makes it a lot more difficult. So this one, you would use table 6A-2. For this one, you would use in the 3rd quarter 6A-4. And this one, you would use 6A-5, the last quarter. All right, so now what's become a lot more popular are 2 depreciation methods, or 2 depreciation types that tax law now allows, or at least temporarily allows. And it's mainly out there to stimulate the economy, because if you get a deduction for depreciation, that makes you perhaps more willing to go buy some more stuff. And if you buy some more stuff, that stimulates the economy and just makes it better for the government as well, because then they get more tax dollars elsewhere. So what it allows you to do, these two methods we're going to talk about, Section 179, this is a term just like makers. Section 179 is something that you just have to commit to memory. Section 179 and bonus depreciation, you've got to commit those to memory, and I will expect that on the test as well, because it's that important that we know what these mean. Any tax person will know what Section 179 means. All right, so Section 179, you're allowed, basically what it does is you're allowed to completely write off a purchase that you normally would have to have depreciated over 5 or 7 years. So instead of taking a little bit at a time, or in like how we do in Accounting 101, because you can use it for 5 years, so you should depreciate it over 5. Tax law says we'll go ahead and give you the break so you can take it off of your income and have lower taxes, and we'll just allow you to write it all off right now in year 1. That's what's considered a Section 179. So with Section 179, you cannot use it on real property. So on any buildings, of course, you can't use it on land. Land can't be depreciated for any reason for tax or Accounting 101 purposes. Limits to Section 179, there are some limits, but they're for the really high-end businesses. Notice you can write off, you can buy up to $1 million of assets every year, as long as it isn't the real property, and completely write it off, meaning you can completely expense every dollar of it in year 1 instead of doing it slowly. Notice there that 1 million, it does begin to phase out. If you purchase over 2.5 million, then the government says you don't really need to be able to do this. You're a big enough company that you can handle doing the regular depreciation methods and taking it slower. So they're saying if you buy over 2.5 million, then you have to start reducing this amount, the million, dollar for dollar that you are over 2.5 in your purchases. So for example, If you purchase 2.6 million of assets this year, you're 100,000 over the top. So therefore, you could only deduct of Section 179, 900,000. The rest you would have to deduct regular makers method. So you could deduct the first 900,000 because you were 100,000 over the max. Notice how much these numbers have ballooned up. Prior to 2010, that 1 million number used to only be 25,000. That's a huge difference. There's a big difference there. And then the ceiling, the 2.5 million, used to only be 200,000. Still a high amount, but not nearly what the 2.5 million is. Okay, some other limitations with Section 179 says you cannot use Section 179 to cause your income to go below zero. So you always do depreciation last. If your net income before depreciation, let's say you're a small business and it's only $4,000, but you bought a $5,000 item, you could only deduct the first $4,000 this year and then carry forward the rest of the $1,000 to next year. Because the 4 minus the 4 would get you to 0, and that's all the lower you can go. And you would have to take the 1,000 next year. You carry it forward. So notice here, unused 179 losses can be carried forward. Now, the one big difference between this year's bonus depreciation and including our next few years, as you can see, 2018 through 2023, compared to the previous years, meaning back through about 2012 or 2010, the bonus depreciation used to only be for brand new equipment, fresh out of the factory. If it was used equipment, but new to you, you couldn't use bonus. Now anybody can use bonus for any type of depreciation, and there's no limit. So technically, Section 179 for the next 5 years is obsolete. There's no need to use 179 because bonus is even better. Bonus, there's no limit. You can take off 100% of your depreciation as long as it's not real property again, because it's got to be less than 20-year life. You can take off all of it right now, no limit. So bonus depreciation, they really hoping that people start buying a lot of stuff to stimulate the economy, whether it needs it anymore or not. It definitely needed it back in 2010, 2011, 2012. Now, I think people got used to it and they don't want to see it go away. So right now, the bonus depreciation will rule the day up through 2023, and then we'll see if it gets extended. It was supposed to go away starting in 2018. It was supposed to start phasing out, but then they extended it and put it on steroids and made it even better. So at the end of 2023, who knows? It still may be there. It may start going away, and Section 179 will then become relevant again. But right now, it's the bonus. All right, the last piece of new thing that I want to mention, and then we're going to go through a couple practice problems in the textbook just to finish out this chapter. I think that's always important, is what's called listed property. With listed property, you can't take a full deduction. Listed property are items that you use, big items that you use for both business and personal reasons, kind of like your home office or the office in your home. You can't use your office in your home for personal business. It's only business. But you can spread out some of the costs, like utilities. Well, kind of the same thing here. With the depreciation, for items that are considered personal property used for both, you can only take a percentage. And then they made it even more when they have listed property that are automobiles. You can only take the percentage up to a certain max. All right, so for listed property, any items that you use at least 50% in business, you have to use that percentage. So if you calculate depreciation of, say, $1,000 and you only use it 70% in your business, you can only take $700. If that was your depreciation as $1,000, you could only take 70%. Notice here it says if you use the item less than 50% in your business, you cannot use the bonus. So you have to use the regular makers and then still only do it by the percentage. So if your amount was 1,000 and you only used it 40%, then you can only take $400. The rest of it is personal and you can't deduct it. For vehicles, they get a little bit more particular in addition. They say with vehicles that are used, and that's why in the tax program, as we'll see here in just a few minutes, I'm going to show you a few things with the how to do depreciation. With vehicles, they ask you, is it a light truck or a heavy truck? They consider heavy trucks in excess of 6,000 pounds, and heavy trucks are considered pretty much completely business related only. Light trucks would be considered a personal type property where it's split, and so therefore you're going to have some caps. Notice the cap here on page 6-17. So you should turn to your book to page 6-17, and it tells you for any vehicles that you buy that it's considered listed property, meaning that it's used for both personal and business property, the max that you can take in year one is $18,000. But then after you figured up the $18,000, you then have to take that even further down by the amount of business use. So if you only used it 80% business, you take the 18, that's the most that's allowed, times it by 80%, and you're allowed $14,400 for your first year bonus. You can't depreciate at all, basically. And so then to give a little example of what I mean, we purchase a new car, we use it 75% business, it costs us $48,000. So if we're looking at page 6-17, we need to have this table up. So make sure you're on that page. And for year one, again, it shows that your limit is $18,000. So $18,000 would be the most I could take, and then I have to multiply that by 75%. So 18,000 times 75%, which gives me 13,500. That is my final answer for that one. And then year two, they tell us the max that we can take. And so on this one, oops, I got the wrong number here. We've got to keep kind of, well, what's left. So I've taken out of the 48,000, I've taken technically 18, even though I wasn't allowed to take some of it, but that still counts. I can't deduct the whole asset because it's not all business. So now I'm down to 30,000 left to depreciate. Out of that 30,000, it says in year two, you're allowed to take 16 max for the bonus. So I can take all of that. So I can only take 12 though of the 70 because it's 75% rule. So 30,000 minus the 16 that I could possibly have taken. So now I'm down to 14,000 that's left. And you can see in year three, the most I could take is 9,600. So I would still have to continue this on through year three and then year four to finish it out. All right, the final thing that I'd like to go through is some of the back of the chapter questions. Go ahead and look at number 38 is our first example to look at. Number 38 in the back of the chapter. So go ahead and turn to there, pause the video, and then here in a few seconds, we're gonna go through the answer. All right, 38 wants to know how much can we deduct, if any, of the expenses above for this business? Oh, shoot, I forgot to go through the tax software for depreciation. We'll do that after these problems. I'll do that at the very end, assuming I don't forget again. All right, so what we're allowed to deduct, let's go through these. The cab fare, yep, we're allowed to deduct that. Gratuity at restaurants, partially, that's considered part of your meals. And remember, meals are only 50% while you're on travel. And this individual is on travel. So they can deduct the gratuity and meals, but 50%. The cover charge, nope, can't deduct that. That's part of the entertainment that's no longer allowed as a business deduction. With the exception is if you have a business, if you have a entertainment for your employees, you can deduct that, that's okay. And that is, again, only at 50% though, just like the meals. These are to entertain clients. You cannot deduct those. So total amount deductible here of $3,250. All right, 39. Let's look at 39. So go ahead and pause, and then we'll go through after you figure out David's AGI. All right, so with this one, we are trying to determine his AGI, and then he has, because he has some home office deductions, we're going to have to take those into consideration. It tells us his AGI before his business, his side business here is 45,000, so that's kind of our starting point. Okay. So we take our business proceeds, and remember, home office deductions cannot exceed your business income. So the most we could potentially take is 4,000. We'll see if we get there. He uses 25% of his home for his consulting practice. So any of those items that are considered indirect would be 25%, and all of those would be considered indirect except the repairs. Actually, I think they took it all. I think they took even the maintenance and repairs as an indirect as well. It doesn't tell us otherwise that if any of them are direct or indirect. So these are it does tell us there. Total cost relating to the home. It doesn't say anything about being business part only except for the depreciation. So we take the 4,000 minus 25% of your interest in tax. Well, excuse me, 4,500 minus the 1,500, your normal business expenses, minus 25% of your interest in taxes, minus 25% of utilities, minus 25% of maintenance. So as we keep deducting these, we're getting closer and closer to zero. So I pull up my calculator. After I take off the business expenses, we're at 2,500. I take off the interest and taxes, I'm left with only 875. Take off the utilities, take off the maintenance, the 25% of the maintenance, and of the depreciation, the only thing that I can take out of the full 1,500, because that is only the office part, I can still only take 387. I can't take the full 1,500 because that would have put me under net income put me at a net loss. So his AGI, it started out at 45,000. We added nothing, so his ending AGI is still 45,000. Adjusted gross income. All right, 41 is again something about travel expenses. So let's take a second, pause, and see what you get for 41. All right, so how much can we deduct on number 41? Airfare, lodging, and meal. Airfare and lodging are all 100%. We're assuming that this was a 100% business trip. Even if it was more than 50%, I could still deduct the airfare in full. That would be fine. You still had to get there. Remember, if it's less than 50%, you can't deduct any airfare. Lodging, for all the days that I'm there for business, I can deduct. So it doesn't say otherwise, so the full 290. I can only deduct half of the meals. I can deduct all the tuition and fees that I had to pay to go to the conference. So therefore, my travel expense would be the 1,470. All right, now we look at a depreciation problem, number 44. At the beginning, towards the beginning of the year in February, we purchased and put in service a car for $21,500. It is used exclusively for business. Compute her cost recovery, assuming no Section 179 expense, but the bonus was taken. Okay. With this one, even though it's considered a luxury car, even though it was exclusively for her business, it wasn't over the 6,000 pound limit. When it's over 6,000 pounds, then it's considered business only, and there is no luxury limit. With this one, it could potentially at some point become used for personal purposes, even though it's not right now. So they do cap you. The most that she could possibly take is the 18,000 because of the bonus cutoff. All right, the last one, 48. What it's wanting you to do for 48 is determine how much can you deduct, calculate the cost recovery for 2010 and 2018 if the real property is residential and a warehouse. So they're wanting you to tell us the depreciation for year 1 and then basically every other year after that. So you're going to have to use the tables 6A-6 and 6A-8 depending on if it's residential or a warehouse. So go ahead and pause and then we'll go through the answers. All right, with 48 residential real property, that's the 6A-6. We bought it in, it says we put in service in January. So the 500,000 times the percentage for January says in year 1 you can take 17,000. In the current year you can take just a little bit more than that. Since we bought it in January, it's not that much higher for the full year. And then you can see what the numbers are for a warehouse. All right, the last thing that I wanted to show you before we conclude this video is on the tax return, the putting in depreciation for your assets. So I'm back at my Joe practice example, and we go back to the Schedule C, which is down here on line 12 of Schedule 1, and we'll put in just a real basic 100,000 income. And when you come down here to the depreciation, we want to click here, and then you always want to go up here to the little folder to start entering in separate assets. So let's say we have a computer that we just bought, and I'm going to show you the 2 different ways, the maker's way and then the bonus or Section 179 way. Either one would work for this. So let's say we put this into practice on February 1 of 2018. I come down here, you have to put in the asset type, so I'm going to put in computers. And let's say the cost was, let's use the 4,000 from our example from the lecture. We had a $4,000, I think it was furniture, but we'll use the same number here. Let's change this one to furniture just so we can keep it the same as our example. So therefore I have to change this because right now with computers, notice the life it shows is 5. If I go down here and I put in office furniture, it's going to change that to 7. It knows that that's a 7-year asset. So using regular makers, this item has a current depreciation of 572. Let's go back to those answers and see if we also got 572. And we did. Here it is. Purchase office equipment or furniture, 7-year life, 572. Notice now I can also put in to see what it would have been if I bought it last year. If I put this in as 2017, tax program knows that, and it knows that this is the 2nd year. So 980, and if we look at my answers, that's what we got as well, 980. Now the one thing I can do then, let's put this back on to 2018. We purchased it for 4,000. Say I don't want to mess around with the depreciation every year. I just want to write it all off right now. So I can go into either bonus depreciation, or I can go into Section 179. Oh my goodness, there's a bunch of them here. It's right here. Section 179, and then simply put in 4,000, and then it's going to have 0 depreciation. For if I come down to my depreciation number, notice there's nothing that shows up. But if I go back to the my Schedule C, the full 4,000 shows up here as a Section 179 if I put it in as such. If I don't, then it's going to show up as that 500 or the 900 amount, depending on the item. The car and truck expense, if you have these with the standard mileage, it's going to take you to the same page, and we still want to do the same process. So I'll put in here let's say we had a car and we put it in service this year, and I come here and I tell that it's a car, maybe a light truck. Either one of these is going to be subject to the limits. But let's say I don't want to depreciate my car. I would rather use the standard mileage deduction. If that's the case, then I need to click here for the business use, and I need to enter in my mileage, because that obviously makes a difference. With business miles, let's say I drove 6,000 miles this year for business, and then I can put this in as well. Let's say I drove another 3,000 personal. So I use the car 66%. Doesn't really matter if you use the standard mileage rate, so you've got to actually click this. It's going to simply look at this 6,000 and multiply it by the mileage rate, which, if I remember correctly, is 54.5 cents. So let's check. 54.5 cents per mile times 6,000 miles, 32.70. Yep, here it is, the standard deduction for standard mileage rate, 32.70. If I go back now to my Schedule C, that 32.70 is going to show up here. All right, that's all we have. It was a long 2 weeks. We had 4 videos, but hopefully you got a lot out of it.